All right, you know what we need, Jess? We need some perspective
Texas?
on this market, and we need some Texas common sense.
Yes.
And our next guest will deliver that. Ted Oakley, he's the founder and managing partner of Oxbow Advisors. He's based down in the great city of Austin, Texas. And we usually talk to you on the phone, Ted, but we got you in the Bloomberg Interactive Broker Studio. He's up in the big town here, which I know is not foreign territory for him. Ted, I'm looking at the S&P 500. It's up 15% year to date. It's up like 22, 23% off of that October low. I'm not sure it feels that way, because it feels like if I didn't own just a couple of stocks, I'm not feeling the love there. How do you think about this market?
Well, you know, Paul, we have a piece coming out next week called the camouflage market, and we talk about these 7 stocks that account for basically 90% of the move. And I think investors don't understand that. They just look at the number, the average, and they think, well, things are great. But I've always said this: you can't start a bull market without a broad move in stocks. Okay, and if you look at the Russell 2000. It's gone nowhere to speak of. A lot of those companies are under pressure. So I think people have to understand that this is very much like the first quarter of 2000. That time we had 16 stocks doing that. All 16 of them, with the exception of one, took over 12 years to break even.
Yep.
So then how are you advising clients to position?
Well, I would say this, we own legacy positions that we've had for many years, actually. We cut them way down. Only 2 we own in that group, or 3, I should say, are Google, Microsoft, and Apple. But they're small positions now for us. They're like 1.5%, 2%. They were large over time. We made a lot of money in them over time. But most of those companies are starting to get, they're fully priced, especially the NVIDIAs in that group.
Yeah.
And so what we do with everybody at this point is we have a 250 roughly stock list that we look at. We'll screen. Very few are in territory we want to buy. And so we're only about a little over 40% invested, probably 45% invested.
So where's the rest of it? Cash?
3 months? No, 90-day floating treasuries.
Okay.
As of yesterday, we were getting 5.28 on them.
Yep.
Really helped us a lot last year. And believe it or not, hasn't really hurt us this year. We're running pretty close to, 65% of the S&P, but not near the risk.
Right.
So then there's been argument about, especially when you see a lot of money going into money market funds and then bond funds as well, when you can yield 5% or more. But then when you look at these double-digit gains, whether you're looking at the S&P 500 or the NASDAQ 100, is that there's that danger of missing out on even bigger returns in the stock market.
Well, Jess, I think people feel that way, and I always tell everybody, there's not a last train out of the station in this business. There's always investable things, and it always will be. And if you're in a long-term bull market and it's going to last 2 or 3 years, you can't score that on the month of June. The month of June's up 6%, you see. So I keep telling people, keep your head on in here, because you're going to find out over the next 2 or 3 quarters where we really are. We're expecting weakness in the economy, so we'll see what happens.
So then what's the catalyst to get you more bullish on stocks?
Well, there would be 2 or 3, but one would be a broader participation. We'd like to see something outside of 7 stocks.
Yep.
And that's one. The second thing would see, if you believe the Federal Reserve, and this is probably the first time in my career outside of Paul Volcker that I've really believed them, I really think they're going to stay high for an extended period of time. If that's the case, you're going to have to wait until you see what happens in this economic situation.
One thing I wanted to follow up on the broad participation, because looking at this month for the S&P 500 sectors, looking at industrials up about 10%, materials up 9%, energy up 5%, financials up about 5% as well, and then technology's up about 4%. You're looking at discretionary up about 10%. As far as the broadening in participation, what's the time period you need to see those other corners, especially cyclical corners of the market that are tied to the health of the economy, continue to perform well for you to get more optimistic about stocks?
Well, it's interesting you say that, because Chance Finucane, our chief financial officer, just put this out yesterday. It came out today, talking about the groups we would fade, which are exactly the groups you just talked about. Because what happens is when people think that we bottomed and we're off to the races again, They buy those industry groups you just mentioned. We go the other way right now. We're in the defensive groups. Consumer staples, utilities. We particularly like gas pipelines. We like steady things right now, and so that's where we are.
How about earnings, Ted? I mean, I'm old school. Earnings matter to me. We're coming up on another earnings season here. What are you going to be looking for this earnings season, and do you think there's earnings risk still in this market?
I do, Paul. I think by the time the year's out, and we have people out there looking for 220, 225 on the S&P. We think we'll be lucky to have 200.
Wow.
When it's all said and done. One of the problems, too, and I think this is unfortunate, but we have allowed companies in the last 10 years to throw everything into non-GAAP, and that's what they talk about all the time. So I'm not certain the average person, they don't really know numbers, can understand what the real earnings are or not. And I think that's thrown a lot of people off, but we'll see. But we're using about 200, which would put us today at about a 21 multiple. That's not a bear market low multiple.
No.
Looking at the projections from Bloomberg Intelligence on the consensus estimates for second quarter earnings season, contraction of more than 8% growth for the quarter. It's something similar we saw coming into first quarter earnings season, but obviously those results didn't come in as bad as expected. We only have about 30 seconds left, but do you think those expectations, the bar is set so low that companies are going to be able to more easily beat once again this time?
Well, Jess, they set their own bars. Usually, and they make a point of doing it. So, yeah, they could get close, I suppose, but I still think, all in all, the next 3 quarters will be disappointing.
Ted, thanks so much for joining us here. Appreciate getting you in the Bloomberg Interactive Broker studio. Typically, we check in with Ted via phone from his Austin digs, but we got him in here, and that's always a good thing. Ted Oakley, founder and managing partner at Oxbow Advisors.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.